Well, that's kind of like that old saying, right? Like history doesn't repeat itself, but it rhymes. And so a lot of what we look at, even though the headlines are different, the data is different, people aren't. People still respond similarly as they always have. I mean, the two strongest emotions that we deal with are going to be fear and greed. Hi, everybody. I'm Jason Rankin.
This is Kyle Triple.
Welcome to another session of the December Monthly Market Matters for Strong Valley Wealth and Pension. Last time you had Chris Connor and Adam Terapelli for the November. You've got Kyle and myself for December. We're going to be popping back and forth, so you'll get a chance to hear from all of us on occasion. Kyle, we made it. I didn't think we'd ever get through this year. This is not an easy year for any scope of imagination. And we had a headline after headline after headline after headline, and it just never seemed to let up. And I didn't think, when I was thinking first quarter of this year, that we would ever get to the end of the year, but we made it. We're alive and onward and upward. Run through some numbers for everybody on how the year capped up.
Yeah, I mean, like you hit, I mean, it's been a rough year period. I know we've said that at the last couple roundtables and monthly marketing matters, but it's really been that way for the entire year. So when we look back on the year, both equities and fixed income have had just poor years. There's no way to sugarcoat it or spin any other way. So the things that we really recognize that drove these markets is we like to reference here in the office is kind of the 3 R's. It's the recession talks, rate hike talks, and essentially the Russia-Ukraine situation that's been going on all year as well. So when we look at those things, that really led to high inflation, right? And the inflation was kind of the hangover the entire year for the markets that caused the economy to slow. Talks of that, ongoing or forward-looking recession, and then led the Fed to kind of implement some of the rate hikes that we're going to talk about here in a little bit. But just kind of summarizing, I know this is the monthly marketing matters, and we usually try to focus just on the month itself. But being that it is December here, the last trading day of the month, we like to kind of just summarize the year too. So as we talked about, really, it's been a rough year for equities. Both the S&P, NASDAQ are down double digits for the year, about 20% for the S&P, 34% for the tech-heavy NASDAQ. And when we look at kind of the international markets as well, they're down about 17% for the year. We kind of summarized the month. We're up about roughly flat for the quarter, but down 3% across the board for those indexes, really 3 to 5%. And the area that's really been just kind of tough for a lot of us, I know we've talked about it, throughout on most of our calls this year, is with more of the conservative clients that may have a little bit higher exposure to fixed income or bonds that aren't used to the fluctuations or the volatility that we've seen in the equity markets in previous years and experienced this year. It's been a rough year for fixed income, and that's obviously with the cause of inflation and the response with the raising rates that the Fed's had. Our bonds are having just a terrible year, and that's made it hard. So the U.S. Ag, which we kind of use to measure this, the intermediate core bond space, was down about 12.5% this year. Fortunately, it's been flat for the last month or so. But one of the things we kind of like to talk about too before we get into interest rates, and me and Jason were just talking about this in the office the other day, is this year's been bad, and we talked about the first half of the year and the market's going down, and it felt like it was never going to end, and it's just been painful. We've had second half of the year that was surprisingly flat, and that's one of the things that we don't realize, because we've still had volatility the second half, but it's been 2 steps forward, 1 step back, or 2 steps forward, 2 steps back. So most of this pain was felt in the first half of the year with the downside, whereas June on, it's kind of been relatively flat to positive depending on the index. So
I think that would surprise most people as well. That and I think the news cycle has not helped, where it just feels like every day is worse. Markets keep going down. But when we actually pull up the charts, we look at the account values, look at the market. Most account values and most charts are the same today as they were in the middle of the summer. And so it's not that it's just keep going lower, lower, lower. It's just the first half was really ugly. Trying to process in all the information, what rates might do, what Russia might do, how bad might this recession be in 23,
or when's the recession going to hit? Just fear that too. And just, is it this week, this month, next year?
Right. And so the real fast sell-off in the beginning of the year to try to anticipate a lot of that pain. And now we're still seeing a lot of digestion going on what that might be. But as Kyle pointed out, it's been flat now for about 6 months.
Yep. So as I mentioned too, I'll lead into this a little bit. Is we really believe that obviously with Russia and Ukraine, that spiked inflation. I think inflation was there to begin with. It just kind of really was the match that lit the fire that made it build up, especially in the energy space there. But the response to inflation was obviously the Fed rate hikes. And here I'm going to pull up a slide here that'll show a little bit what the Fed has done this year. They've been extremely aggressive all year long, really, in responding to the increase in inflation. A lot of people will talk about whether or not they were late to the game or should have done more sooner. But bottom line is there's been 7 rate hikes this year, from starting back in March at 25 basis points, 50 basis points in May, and really the 4 that happened in the middle of the year from June through November at 75 basis points. Just unprecedented. We haven't really seen that level and that speed of rate increases. And then we finished off with our most recent one here in December at 50 basis points again. So when we're looking at the Fed fund rate, that started the year at the target range of really 0 to 0.25%. And we're finishing the year now at 4.25% to 4.5%. So that is a huge jump in interest rates. I know that most people that have been in the market of buying a home or refinancing recently have seen the impact of those rate hikes. The other side of it is that's also been a huge drag on our fixed income and the bonds, and the reason we've seen the performance we have in the down year in the fixed income. But one of the things we will highlight too is we've talked about this with a lot with clients, that the only real silver lining with the raising of interest rates that we've seen this year is in our fixed income, as far as the interest that they're paying and our short-term stuff. So it's been a long time since we could sit down and give a CD rate with a decent yield on it, or even money market. I know most of the clients that have been sitting on cash for extended period of time have been used to getting 0.2%, 0.4%, and just next to nothing. Fortunately, with the rate hikes that have come, the beneficiary of that has been the short-term, the fixed income. So I know that we have money market rates that are paying right around 4%, 4.25% right now. And we just bought some CDs this last week for a client that was 6-month CD it's paying 4.5%. So it helps with people that have cash on the sidelines with opportunities to get that money yielding a little bit more interest, where a lot of the banks are still paying under 1%. So just one plug there that we'll throw out that's a beneficiary of those rising interest rates.
Right.
But a lot of that, obviously, the reason for the raise in rates was to combat inflation. And so Jason, you want to highlight a little bit about the inflation we've seen this year and kind of the impact that we're seeing?
Yeah, absolutely. And this kind of leads into what we anticipate the Fed doing next year. There's a lot of uncertainty around what the Fed might do and how aggressive they might be. But Jerome Powell, he's been pretty vocal on what his desire is with the interest rates and why he's raising them, and what he's actually using as information to react to. And so the whole reason for the interest rate hikes is to slow down inflation, curb inflation, to get it down to a level that they're comfortable with. And I think that level is still kind of to be determined, but let's just say somewhere between 2% and 4%, and we're above that. And I know that for Kyle, myself, Chris, and Adam, we all believed earlier this year that the pressure on the stock market was really kind of driven by getting inflation handled, getting inflation curbed, because without inflation plateauing or going down, there was no end in sight for where rates might go. And so you'll see a chart here. I'm going to pull up that what inflation has looked like throughout this year. You can see that inflation peaked around, I think that's June. And so even though inflation is terrible by any scope, we're still at 7%. What you're seeing here is it's getting less worse, if that's a good term. And so the market is reacting positively in that we said a moment ago that the stock market is flat over the summer, and you can see that's about where inflation peaked. And so the optimism here is that Jerome Powell and the Federal Reserve, they might raise rates 1 or 2 times to begin in 2023. But if they begin to see inflation dropping at the rate that it's been dropping since June, we're optimistic that they're going to slow down. And then there's some people in the other camp that say, okay, if inflation really starts dropping, then there's a chance that sometime next year they might even begin cutting rates. We don't know that yet. Kind of depends on what happens if we go in through a recession. But this is what we're seeing with inflation. And so,
and Jason, that ties back into some of the conversations we've had previously on our quarterly roundtables and our previous monthly market matters as well, that we kind of said that one of the data points that we were looking for following this year was inflation. And we said we won't know when inflation peaks till it's already peaked and it's down the line. And that's
Right.
because it's rear looking, it's rear view mirror. So we thought the markets would start to stabilize and potentially recover when everybody kind of feels that has happened. And as the slide shows, and that we've just talked about, that 9% number that we saw in June appears to kind of be that peak. And it's been a very slow but downward trajectory since then. I think that's, like you said, kind of the reason we've seen kind of more of the flattened markets between June and now.
That's right. And when it comes to news like this, and it can be inflation, or frankly, I mean, it could be anything, any kind of news cycle, is that the stock market can go up even if the news is bad, as long as it's less bad than what was already baked in, what was priced in. And so if awful sustaining inflation is what was baked into the cake, and it is now still high inflation, but it's dropping, the markets can actually go up in spite of that, as long as the news is bad, just less bad than what we had already priced in.
Yep.
And so that's some optimism I'd like to see heading into 2023 is inflation stay curbed. I can't imagine having rates this high can't slow things down. And, if you talk to anyone that is in the market to buy a home, they're pausing. They might just remodel their home as opposed to moving. If anyone, what we're seeing too, if you talk to anyone that owns a business, they're not that excited to go out and hire a bunch of new people right now in fears of what might come with the recession next year. And if you think of anyone that that might want to start a business, they're probably sitting on their hands for a while. And so when you've got fears of recession out there, kind of think of it like, we're dealing with a lot of weather right now in California. And you can think about it like this, think of someone when you see the news, when there's the hurricane off in the Gulf, heading towards coastline, and they're fearful that it's a Category 5 hurricane or something that might hit shore. Even though it's not going to come for a while, everybody's boarding up their windows and everybody's preparing for this storm that might come through. And so what we're trying to figure out is really how much of this cake is baked for 2023. There's a lot of bad news and a lot of fear that's coming, or a lot of fear that's here because of something that might come. And even if it's a Category 2 hurricane that ends up coming through the country, if everybody prepared for a Category 5, the markets could actually go up in spite of that.
And that's what we talked about too on previous calls or podcasts, as well as just in the office here, is, a lot of times we talk about the market is kind of a leading indicator. And so it's already baked in and just, feels the pain of a recession, or expecting a recession. And that's why we've seen a lot of the downside that we've seen this year on top of the inflation and the rising rates. And so a lot of that we were talking about in general, as far as what we could see next year, and potential for still some optimism. I know we focused on a lot of the negative this year with the interest rates, performance, rate hikes, recession, all that kind of stuff. But historically, we were talking, when we have these years where things are down, and then the response to these years as far as comeback potential, what were some of those numbers you were throwing around earlier, Jason, that you were highlighting with bad years and then response for the year followed, both on equity and fixed income markets?
Yeah, exactly. And, this could always be an outlier. It feels like everything since COVID has been an outlier type of year. Sooner or later, we are going to revert back to the norm, revert back to the mean. And in looking in some past years, when we have dealt, when this country has dealt with pullbacks like we've seen, going back to World War II, the stock market has only had 3 years worse than what we just went through. It was 1974, 2002, and 2008. And all 3 years following those years, 1975, 2003, and 2009, stock market was up double digits in all those cases. In many of the cases, like I use the hurricane metaphor there, is that everyone baked in this awful thing that was going to happen. And it's not that 1975, 2003, and 2009 were just stellar years in the economy. I mean, we were still climbing out of holes that we were in. Yeah. It's just that we had priced in so much awful news that it was like, well, okay, it's a little less awful. And then the market recovered from that. We also saw that in the bond market. Mm-hmm. Only 3 years, this will go down as the worst bond market in this country's history. But the 3 years that were close were 1994, 2009, and 2013. And then the 3 years following those years, 95, 2010, 2014, the bond market was all up nearly double digits in each of those years. And so quite often what we see is that when things really, really sell off, you see money come back, you see investors come back. And as long as countries continuing to move forward, people go to work, people are going to need to find a spot to put their money. So We shall see.
And that's history. Obviously, we can't guarantee that next year is going to be a year where we get double-digit returns. I wish that was the case where we can make those guarantees and make it happen. But it's just more of looking back. A lot of what we do is forward-looking with data and data points that are being out there. But it's also looking back at history and how markets and really people have responded to bad times. And that's kind of what we're reflecting on there or hinting at. So.
Well, that's kind of like that old saying, right? Like history doesn't repeat itself, but it rhymes.
Nice.
And so a lot of what we look at, even though the headlines are different, the data is different, people aren't. People still respond similarly as they always have. I mean, the two strongest emotions that we deal with are going to be fear and greed. And we see that ebb and flow all the time. And so quite often humans react similarly regardless of the news cycle.
Right.
Quick segue. One thing I want to touch on briefly is something that just passed here in our country was the gigantic spending bill that just got passed by both the Senate and the House. $1.7 trillion to keep the country running. And just a couple points, I didn't read all 4,000 pages. I don't know if anyone has, but I'm going to give you a couple nuggets that I grabbed from research that I did to summarize for folks that just kind of want a quick update. So of the 1.7 trillion, about half of the money went to defense spending, and about half the money went to non-defense spending. And so a couple nuggets out of that, there was about another 45 billion off to Ukraine. There was one thing that I thought was kind of ironic that they threw into this, but I'm glad they did. TikTok was banned from all federal devices. Probably wouldn't be such a bad idea if it was banned from all of our devices, but they're starting with federal employees, which is probably good considering the amount of information that is donated by anyone who's on TikTok. Other things that I liked out of it is they increased medical benefits for veterans. That was a good thing that I believe that went in there. We also saw some things directly related to our industry in regards to retirement savings. So they did adjust things like the required minimum distribution age for retirees out of their IRAs, 401ks, et cetera. That's going to move to age 73 this year for anyone who has not started requirement distributions already.
Starting in 2023. So
correct, starting next year. And then that's going to jump up to 75, but not for another decade. Other things that we saw is that they're going to allow people to save more money into their 401ks, jumping up the catch up, when you're in your 50s and 60s. But again, these things are great, but they're not going to take place until 2025. So those are things we're definitely going to research more and look more into. I'm sure there's a lot of other items in there, but those are some of the big ones that I grabbed. But it's amazing how much money this country can spend very easily,
very quickly. Yep.
Kyle, anything else you want to touch on?
No, I mean, I think the keys to these, as we talked about, was trying to keep them short, 15 minutes or so, and just give you a summary of what we've seen for the month and the year. Obviously, we get a lot more detailed in our quarterly roundtables. We do encourage everybody to go to our website, strongvalley.com, and you can check out our resources there. We have all of our previous podcasts, any events that were coming up, as well as just information on all of us and our company. So with that being said, I just really want to thank all of our clients for 2022. Thanks for sticking it out with us. It's been a rough year, as we hinted, and we know that there's always light at the end of the tunnel, and we look forward and are hopeful for a better 2023 and on. But thank you all for taking the time to tune in and be a part of this. And we just wish you, your families, and your friends a good and prosperous 2023.
Happy New Year, everybody.
Thank you all.
Talk soon. Bye then.